Sydney property has fallen. Let's have a look. Hello everyone, Florian.heise here and welcome to another episode of HeiseSays. Grab your stein of coffee, but you may want to add some rum or beer to it this time because I've got sad news. Property in Sydney has declined, according to CoreLogic, for the first time in 17 months. This is going to shock the entire Australian economy. How will we handle it, everyone? Property always goes up, doesn't it? It only ever goes up. It never goes down. Not in Australia. We're different. We're the lucky country. We're special. Growth in Australian housing values continues to lose steam as Sydney records the first decline in 17 months. So this is from CoreLogic, everyone. So there you go. The Home Value Index posted a 0.6% gain in February, the 17th consecutive monthly increase. So it's still going up in the national HVI. While housing values are generally rising, the pace of growth in the national index has trended downward since April last year. So steam is running out in this, well, we'd all have to say, insanely overheated market. I wonder why that is. Well, let's have a look. I'll bring up this chart here just to show you how government has been juicing the market. We've got an insanely low cash rate. 3% was an emergency. What's 0.1%? You've got home builder overheating the housing sector, and building approvals have bounced again. So we'll have a look at that in another video, but building approvals have jumped back up again. You've got grants, handouts, discounts. When I did this slide, it was 88 grand. Now it's 200,000 in Tasmania. If anything, that should tell us that there's some fundamental things wrong with our market, and the government intervention, well, more of the same. It's just going to exacerbate the problem. But people don't want to look at the long term. They only want to look at the immediate and best deal for them. And, well, frankly, I can understand that. You've got 5 and 2% government loan guarantees, sort of the norm. Negative gearing is part of our culture. And then these super withdrawals, which, understandably, again, a lot of people put into their housing. So we've got all of this, and now we're seeing a decline in Sydney prices. Let's bring up another chart here. I want to bring this one up from the property. This is asking prices in Sydney, and I'll just full screen it and reload so you can see there. Okay, it's going down, but look at that climb, guys. We'll have a look at Melbourne. Here we go, and this is from SQM, and I'll just reload this page. You can see again, same type of thing. Good old Brizzy, my city, it's just stupid. Brisbane is just stupid. If we go back here, 2020, you're talking 655. And with a 20% deposit, that is a mortgage which isn't that bad. That's for all houses. 3 bedders. Hang on, 3 bedders down here. 570. Okay? Even with a 5% or a 10% deposit, you're still going to be okay there, even if rates go up. Sure, you'll be struggling a bit. But now look at it. 700. Hang on. 798, nearly 800 grand for a 3-bedder in March 2022. So, yes. February's growth of 0.6% marks the lowest monthly growth reading since October 2020 and is down from 1.1% in January and the cyclical peak of 2.8% in March 2021. According to CoreLogic's Director of Research, Tim Lawless, every capital city and broad rest of the state region is now recording a slowing trend in values growth, albeit with significant diversity. Sydney and Melbourne have shown the sharpest slowdown, with Sydney negative 0.1 posting the first decline in housing values since September 2020. There you go, 0.1. The end is nigh. I mean, it's nothing. 0.1 is hardly anything, but that's still a decline, everyone, and that's going to have an impact. So, Melbourne was flat following December and January. Conditions are easing less noticeably across the smaller capitals, especially Brisbane, Adelaide and Hobart, where housing values rose more than 1% in February. Similarly, regional markets have been somewhat insulated to slowing growth conditions, with 5 of the 6 rest of state regions continuing to record monthly gains in excess of 1.2%. Now, this is per month, everyone. This is monthly gains. This is not yearly gains in line with inflation. This is per month. So if you annualize if you get 1% every month, that's going to be more than 12% because you're compounding on the growth of growth. The stronger housing market conditions in Brisbane and Adelaide can be seen in the quarterly growth figures, with Brisbane housing values rising 7.2% over the past 3 months to February, while Adelaide is up 6.4% over the same period. At the other end, the capital city growth spectrum, Melbourne values are 0.2% higher over the past 3 months, while Sydney values have risen 0.8%. With the trend in housing values losing pace over the past 11 months, the annual growth trend turned in February. Nationally, home values were 20.6% higher over the past 12 months, down from what is likely to be a peak rate of annual growth recorded at 22.4% last month. I mean, that's just crazy, but you've got to understand this big 22.4% growth is coming off a decline because of COVID. Regional Australia continues to record a substantially higher rate of growth than the capital cities. Over the past 3 months, housing values across the combined rest of state regions increased at more than 3 times the spending of household values across the combined capital cities, 5.7% and 1.8% respectively. Although the rolling quarterly rate of value growth remains rapid across the regional Australia, conditions have eased from a recent peak of 6.4% over December quarter and is down from a cyclical peak of 6.6% in April last year. Regional housing markets aren't immune from the higher cost of debt as fixed-term mortgage rates rise. These markets are also increasingly impacted by worsening affordability constraints as housing prices consistently outpace incomes. However, demographic tailwinds, low inventory levels, and ongoing demand for coastal or tree change housing options are continuing to support strong upward price pressures across regional housing markets, Mr. Lawless said. The slower growth conditions in Australian housing values goes well beyond the rising expectation of interest rate hikes later this year, Mr. Lawless noted. The pace of growth in housing values started to ease in April last year, when fixed-term mortgage rates began to face upwards pressure. Fiscal support was expiring and housing affordability was becoming more stretched. With recent global uncertainty and the potential for weaker consumer sentiment amidst tighter monetary policy settings, the downside risk for housing markets has become more pronounced in recent months. So let's have a look. Here we have the change in dwelling values monthly. So there it is. There's the big news. The negative 0.1% in dwelling values in Sydney, where the median. So median is where you have, smack bang on the curve. Oh wait, that's a terrible curve. Here we'll go. We'll say this guy here is our curve, and we go smack bang in the middle. 50% is one side, 50% is the other. That's the median, everyone. So in Sydney, it's 1.1 million with change. Melbourne, 799. Remember, these are going to be different to the asking prices that we're seeing from SQM, which is what I brought up there. Brisbane, 722,000. Adelaide, 593. And Perth, 535. Hobart, 724. Shit. That's insane. Hobart's just going crazy, guys. Don't get me wrong. Hobart is a beautiful city. I love Tasmania. It's cold as anything. I used to work for a firm that had their office based in Tassie, and I'd go down there for training. It'd be so bloody cold. This was in Lonnie. Beautiful city. And Hobart too. But 724 grand? That's the Victorians, I think. A lot of them driving up the prices in Tasmania. Darwin, 495. Canberra, 909. The combined capital's 800. Regions, 564. So national, 728,000. So advertised inventory levels help explain the divergence in housing market and housing growth trends. Nationally, the total number of properties advertised for sale over the 4 weeks ending 27th of February was 13.3% lower than this same period a year ago, demonstrating an ongoing shortage of available housing to purchase, at least at the macro level. Despite the low total listing count, advertised supply levels are gradually normalizing after tracking close to 25% below prior years' levels before spring 2021. While some cities, such as Melbourne and Sydney, have seen advertised stock return to more normal levels, other Australian capitals are continuing to record extremely low inventory. So supply and demand is impacting this. You need to increase supply then. You need to incentivize and make it easier for people to build. But the not in my backyard crowd will stop that. They'll do everything to oppose it. In Melbourne, advertised stock levels are now above average, tracking 5.5% higher than a year ago and about 4.7% above the previous 5-year average. The trend is similar but not quite as advanced in Sydney, with total advertised stock 6.3% higher than last year, but still 4.2% below the previous 5-year average. Mr. Lawless said more choice translates to less urgency for buyers and some empowerment at the negotiation table. The cities where housing values are rising more rapidly continue to show a clear lack of available properties to purchase. Total listings across Brisbane and Adelaide remain more than 20% lower than a year ago, more than 40% below the previous 5-year average. Now that's huge, everyone. Well, that explains why property is just going nuts in Brisbane. Here's the thing. Why would you sell? Why would you sell an investment property in Brisbane? You've got the government is just going to be wasting money on the Olympics. There's going to be infrastructure built there, and they're still more affordable compared to Sydney and Melbourne. If you don't have to, here's the thing with property. People aren't going to flip it like shares or crypto. There's a big cost to transact. It's not as cheap. You can't just sell a house for $7. Similarly, the combined rest of state markets continue to see low advertised supply, 24.9% below last year and almost 45% below the 5-year average, he said. The trend towards higher overall stock levels in some cities can be attributed to a combination of more newly listed properties coming to the market, coupled with a softening in demand caused by worsening affordability, higher mortgage rates and lower levels of housing-related sentiment. The flow of newly listed properties was 11.3% higher than a year ago in February and 1.27% above the previous 5-year average. The pace of rental growth has shown a subtle rebound over the past 2 months, which can initially be attributed to the seasonal strength in rental markets through the first quarter of the year. Nationally, CoreLogic's Rental Value Index, which utilizes a hedonic regression methodology similar to HVI, was up 0.8% in February, holding firm from January's 0.8% and up from 0.6% growth recorded in December. The February rise in rents was focused within the unit market, with the National Unit Rental Index up 0.9% over the month and 2.4% higher over the rolling quarter compared to 0.7% and 2% for houses respectively. According to Mr. Lawless, this stronger trend in unit rents is most visible in Sydney and Melbourne. Anecdotally, demand for unit rentals in the cities has been bolstered by a combination of worsening rental affordability, deflecting more demand towards the higher density sector, where rents tend to be lower and demand starting to return from overseas arrivals, he said. With the pace of growth in housing values softening, while rental growth holds reasonably firm, the gross yield profile has finally stabilised at 3.2%, the lowest rate on record. Sydney 2.4 and Melbourne 2.8, which have the lowest yield profiles, recorded a slight strengthening in gross yields this month, as rental growth nudged higher than growth in housing values. According to Mr. Lawless, we could be seeing rental yields move through the bottom of their cycle. After several years of yield compression, where gross rental yields reached historic lows across most of Australia's capital cities, we're finally seeing early evidence of yield repair. If rents continue to rise faster than housing values, which is strongly possible in Sydney and Melbourne, yields will continue to improve. Cities such as Brisbane and Adelaide, where housing values are still consistently rising faster than rents, are likely to see yields compressed to new record lows. Despite the downward trend, yields in these cities remain well above Sydney and Melbourne levels, Mr. Lawless said. So there we go, everyone. Let's have a talk about this. A 0.1% fall in Sydney is, I think, psychologically it's important because, remember, there's the whole housing only ever goes up crowd. But maybe we're starting to see the end of the insanity. Is the market starting to cool down? Well, certainly not in Brisbane, and certainly not in some of the other regional cities, but Sydney and Melbourne, the de facto property capitals of our country, are they starting to go off the peak? What do you reckon, everyone? Let me know your thoughts on this one in the comments down below. Thank you all for watching. If you're a fan and enjoy the content I find and put together here, there are a few ways you can help out. You You can join us on YouTube or Patreon, sign up for SelfWealth or Stake, or use our affiliate links at Amazon, eBay, Independent Reserve, or AussieBroadband. Take care, everyone. Have a great day, and I will see you in the next episode of HeiseSays. Bye for now. How's it going to be if Brisbane catches up to Sydney? It's just getting stupid. There you go.